All right, let's get rock and rolling. Welcome back to Lunch of the Market. We're going to jump right into it and talk about yesterday's call on Broadcom, ticker symbol BRCM. We had a put butterfly on. What does a put butterfly looks like? It looks like long and short put spread on the same stock with the pivot point being the short strike. For instance, 45-41 long put spread, the short strike is the 41, and then you add, or you sell, a 41-37 put spread, and it kind of looks like a butterfly, I guess, right? The math looks 2 by 4 by 2, right? 2 at the 145 long, 4 short at 41, and then 2 more long at 37 as your hedge. What we did today, those long 45 puts were up 173%. We said, thank you very much, Mr. Market, for your gain. We took them out, and we used, in the same transaction, we bought 2 more 37 put spreads. So we basically converted our put butterfly. We took off the long side, and then that left us with this, and then we basically just added those 37 puts. So in effect, we're now short 4 41-37 put spreads. Does that make sense? Hopefully so. If you've got questions, just send us an @message on Twitter or leave feedback on our YouTube video when it comes up later today. And that's basically how we turned our put butterfly into a short put spread trade. We basically did the same thing with Amazon. Worked out beautifully there as well. In the case of Amazon, because there was enough premium left, we actually sold some more 160, 155 put spreads in Amazon. Looking at the premium in Broadcom, the market really thinks that the move that we've had is all that we're going to see. The puts, I think we paid 6 cents for the 37 puts, and the 41 puts were only about 30 cents. And that's nowhere near the risk reward we want to sell additional spreads. So we just wanted to let those 41s go expire worthless, and so we added the hedges at the 37 strike. All right. Events like earnings reports tend to suck volatility out of the options market, since an unknown becomes a known, and many times the next catalyst isn't for a few months off. So unless guidance on the call from management is extremely bullish, a lot of times that's it for the volatility, and that's why selling that downside strike as part of the butterfly, right? Selling this works out really well because volatility comes out. A lot of times, regardless of what the stock does, as long as it doesn't break this strike, this becomes worth a whole lot less because volatility comes out. Okay, in addition to flipping the butterfly, right, basically like this, we just doubled down on those short spreads. We got long the January 2012 30-45 call spread on Broadcom. We like Broadcom, we like Qualcomm, and we mentioned yesterday in the show that if we saw a material decline in the price of the stock, that we would actually look to add exposure from the long side. Well, the stock is trading at around $42.75, and so we're way, way in the money. The spread costs us $9.40. Max profit is to get to $15. You do some quick math, right, and it comes out with about $560 is what our profit will be. Take $560, divide it by $940. It's about a 59% rate of return in 11 months. Not too bad. So we paid $940 for those January 2012 30-45 call spreads. All that is a long January 2012 30 call, and then short the 45 against it. This basically reduces the cost and says, look, I don't think Broadcom will go to infinity, but 45 seems like a reasonable number. Where our break even is all the way down at 39.40. So the stock can continue to decline for several points before we even be concerned about going less than break even. It's a great strategy. We like it. You know that when we buy options, we do it way out on the calendar, so we give ourselves time to be right. We continue to sell those Netflix 195, 190 put spreads. Today I think we got somewhere between 70 to 80 cents for those. The calendar's on our side. There's only 17 days left until options expiration. Only 12 of those you can actually trade. So Netflix could logically decline by about $1 a day, and we'd still be just fine on options expiration on the 18th. So keep that in mind. We also added to our WBC call spread position. I wish we would have caught CMI yesterday on the dip after they reported. We're fans of both truck-related names, and we buyer of WBC and CMI on any material weakness. Okay, finally, Freeport-McMoRan, the 2-for-1 stock split is now finished. Look, the stock is now attractive and affordable to a much wider range of investors, with the stock trading in the 50s now. Regardless of what your position was before in Freeport-McMoRan, I would strongly consider being long this stock. Many times they pay a special dividend. They generate an enormous amount of free cash flow. They have an extremely clean balance sheet. And before the split, they were trading right around 10 to 12 on a PE basis, and that's for trailing earnings. Forward was closer to a single-digit PE. So take a look at FCX on the 2-for-1 stock split. I think the stock will probably be back up around the $100 level in a year or two. Should be a good rate of return. Thanks for joining us again today. Last night's America's Favorite Traders episode with Jared Levy was fantastic. We're working very hard this week to get that out on iTunes and up on our website at magnumopusfinancial.com. In the meantime, don't forget to check out last year's episode with Jared Levy. Go on iTunes, search Magnum Opus Financial, and you'll find our 8 episodes of America's Favorite Traders. Thanks for joining us again today on Lunch in the Markets. See you tomorrow.